The major US stock indices continues to tumble yesterday due to AI jitters arising from Oracle debt financing AI-related data center deal. The US dollar rebounded as expected ahead of today's key ECB meeting, Bank of England meeting, and as well as the release of November core CPI data. Good morning to all. I'm Kelvin here. Welcome to today's Daily Dose of Market Insights. Today will be the Thursday, the 18th of December 2025. So as usual, before we jump straight into the gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay, give me a minute. All right, so as usual, before we jump straight into the intraday technical outlook charts, which is I will share with you some of the charts will have a refresh level due to yesterday's movement, especially on the three major US stock indices that we cover on a daily basis, which is the S&P, the Nasdaq, and the US Wall Street 30, representing the Dow Jones Industrial Average. Let's have a quick look what has taken shape yesterday. So yesterday movement is more primarily focusing on the fear of this AI leverage financing by Oracle. So there's this particular news flow that causes a negative feedback loop in the US stock market yesterday. So if you look at this particular news flow is regarding Oracle. So we know that Oracle is part of this circular financing AI deal where they promise to actually help the OpenAI to beef up their data centers. And by beefing up data centers, they will purchase OpenAI. We call it with OpenAI will have that revenue from Oracle and go and purchase NVIDIA higher end Blackwell semiconductor chips. So it's a circular financing thing. So as well as part of this player in this circular AI finance got hit by negative news flow, it will drag down the entire AI bullish narrative template. So yesterday, this particular news flow was negative, hit Oracle again. So Oracle in the last 2 weeks has been hit by lots of negative news flow. The first news flow was potentially a kind of a reduction in revenue outlook next year, followed by this data center build-up that likely to be delayed. And this data center build-up is for one of its client, which is OpenAI. So yesterday, there was this split over data centers that rattles banking on AI boom. So Oracle stock fell yesterday after it was confirmed that Blue Owl Capital, which is a private equity fund, is not contributing equity to a data center project in Michigan. All right, so it means that potentially Oracle could face a bit of a cash flow issue with the lack of equity financing from a private equity firm, and market feel that Blue Owl Capital is the first one. Who knows, there will be other because PE firm that starts to withdraw their support on Oracle. So that created a negative feedback loop into the US stock market, where we see all four of them close in the red. The SPX is down by negative 1.16%, the Nasdaq down negative 1.93%, the Dow Jones Industrial Average down negative 0.47%, and the Russell 2000 down negative 1.07%. And if you look at the heat map of the S&P 500, we see a carpet of deep red among the semiconductor stocks. So Oracle, part of being the key players in this AI financing loop, AI circular financing loop, I would say, spreading into the rest of the other chip maker, which eventually kind of supply their chip to one of their major customer will be OpenAI. So that has a kind of a negative feedback loop being circulated around once one of the key players got being hit by this wave of negative news flow, which was Oracle yesterday. So we see a slew of deep red among all the major US semiconductor stock, dragging the Nasdaq 100 down for sure, given the fact that the Nasdaq 100 has been heavily skewed towards semiconductor AI play, especially NVIDIA is the biggest weightage component stock inside the Nasdaq 100. Despite the fact that we see pockets of green in other US sector like the consumer defensive, utilities, real estate, energy, and some form of the finance as well, in insurance and some pockets of green and healthcare. That doesn't allow the S&P 500 to close in the green, because this particular groups itself has a lower weightage inside the S&P 500. So despite 4 sectors in the green yesterday, energy, basic material, consumer defensive, real estate, they are unable to actually lift the US stock market into a positive territory, given the fact that the communication services and the technology sector all close almost 2%, especially the technology sector is down by negative 2.25%, followed by the communication service, which is also part of this AI team play, down negative 1.79%. And was still the industrials got hit as well, which dragged down the Dow Jones Industrial Average yesterday, which was down negative 1.72% from a sectorial perspective. So net overall, a negative day for the US stock market, and potentially that will share with you the Nasdaq 100 chart. Yesterday we were neutral, so the neutrality level has the neutrality range has starts to turn back to a bearish bias by yesterday's end of day data. So later I'll share with you more of the chart on the Nasdaq 100. Next up will be the FX market. So the FX market, we start to see the dollar strengthening yesterday, which is came in with our expectation due to this positioning of short-term speculators ahead of this key risk event today, which is the outcome of the Bank of England meeting, ECB meeting, and as well as the release of the core US CPI data. So despite the fact that even though we have a kind of a comforting news from one of the senior affluent Fed official, which is Fed Weller. So Fed Weller, based on his public speech yesterday, he wants to have a lower interest rate. That means, i.e., in his opinion, interest rate should be lower, but he see no rush to cut. All right, so that also keep interest rate cut cycle alive in the US, but except only that the pace of the cutting, all right, over here. So if you look at the CME Fed Watch 2, market participants are still looking at a high chance that the Fed will not do anything or will not cut and will not hike and stand pat on the next meeting on the 28th of January next year, which is 28th January 2026. Still about high rate of 75%, 76%, almost unchanged compared to a day ago, which is also at 75.6%, and a week ago it was 73% or 74%, right after last week FOMC meeting. So no change for 28th of January, stand pat at 3.5%, pardon me, and 3.75%. But interestingly, if you look at the aggregated tab, where we're able to see the probability of the interest rate cycle by the Fed going forward into the next few meetings in 2026, market participant is still looking at a high chance that the Fed may move on the 18th of March 2026. That means another 4th cut this time in this ongoing interest rate cut cycle, to bring the Fed funds rate down by 25 basis points to 3.25% and 3.5% on the 18th of March. All right, so that is about 63.5%. The higher chance will be at 89% on the 29th of April 2026 FOMC meeting. And very interestingly, the second cut of 2026, or put in a way that the 5th cut of 2026 potentially may come in on the 29th of July 2026 FOMC meeting, with a rather high chance of 71% to bring the Fed funds rate to 3% to 3.25%. And what's interesting over here is that as we go down the calendar, all right, on the last meeting of 2026, 9th of December, now there is a growing odds, haven't reached the 50% yet, but now went up to 40.8%, that the Fed may engineer the 6th cut or the 3rd cut for 2026 to bring the Fed funds rate down to 2.75% to 3%. All right. So the last meeting of 2026 is like a coin flip over here. So for 59% chance that the market participants expect the Fed to stand pat after 2 potential interest rate cut, the one coming in potentially April and July, then thereafter stand pat all the way. But now there is a growing probability of 40.8%. Previously, yesterday is about 30%. So this growing probability of 40% that the Fed may engineer 3 cuts into 2026, or in total 6 cuts in the current interest rate cut cycle, is likely due to Fed Weller's remark that he wants a lower interest rate, but he hold back, stating that no rush to cut. He give a bit of what I call a wild cut for the pace of interest rate cut going forward in 2026. So overall, that potentially could still support a weaker dollar, except the fact that now the dollar is doing a potential mean reversion rebound over here to retrace 2 weeks plus of decline. So yesterday it rebounded, tested our first resistance at 98.66 before trading downwards again. But if you look at the overall candlestick on the daily basis, it doesn't form any bearish exhaustion candlestick. And in fact, the close of the candle or the candle body managed to be bigger than the bullish hammer candlestick body that formed on the 16th of December that triggered off this potential intraday rebound that took place yesterday, 17th of December, as we are speaking right now, 11:16 a.m. Singapore time. And right now, the dollar index trying to actually shape another positive follow through as well. So potentially, given the fact that from a technical perspective, it could do that mean reversion rebound, a breakout above 98.66 could potentially retest 99 figure level, 99.25, which is the confluence with the three moving averages, the 20, 50, and the 200-day moving average. All right, so that's the situation for the FX market. And given the fact that the sell-off in the US stock market yesterday created by this jitters among the AI circular financing situation, culprit being Oracle, created a risk-off impact on the Aussie dollar. So we know that the Aussie dollar has a very close proxy with risk-on, risk-off, especially in the global stock market, given this global situation right now where AI is being a major team play in the last 3 to 4 years for global equities. We start to have a negative feedback loop on the Aussie dollar today. So the Aussie dollar managed to shape a K-shaped performance. That means the dollar is the strongest against this risk proxy currency, which is the Aussie dollar. So based on the 5-day rolling performance basis, the Aussie is up by 1%. Then with the Aussie being weakened against the dollar, the Kiwi was dragged down as well, where the dollar Kiwi is up 0.77%, being the two strongest being the dollar is being the strongest currency right now against the risk-off proxy, which is the Aussie, dragging down the Kiwi. So that this kind of a K-shaped performance on the very short-term basis in the FX market. So this is the 5-day rolling performance of the US dollar against the other major currency as of now speaking, 18th of December, 11:17 a.m. Singapore time over here. So with that, then there's another positive news flow coming out from China over here. So the CSI 300 index over here. Give me a minute. Let me share you guys. All right, managed to stage a bounce in early Asia session. So off from its intraday low, the CSI 300 over here, okay, down negative 0.62%, but it managed to inch up slightly higher due to the fact that this China property debt woes by one of these major developer, China Vanke. So China Vanke debt talks expand as it seeks more time from banks. So there's some kind of promising talks on the table where China Vanke creditors allow it to extend its debt repayment interest payments on certain borrowing over here. All right, so at the moment, the developer is struggling to keep up with this timely so-called interest rate payment to bank loans as well as bond holders. And that also created a negative feedback loop in the last 2 weeks on the China A-shares market, spilling over to the Hang Seng indices over here. All right, so with that, that sum up the first segment of the daily dose. Now, let me move on to the second segment of the daily dose, which is the intraday technical outlook charts over here. Okay, before that, let me expand my screen so that you guys can look at the screen. All right, over here. Okay. Okay, let's start with the FX market first. Okay, but before that, just to make sure that everything is good on the screen over here. Okay, should be fine. Okay, seems to me that that's a bit slow on the internet. All right, so I think it should be okay. I'm not sure the screen is not showing. Give me a minute. I think it's stuck over here. Test, test, test. Right, why it's not showing? Okay, so hopefully the chart is up. Okay, how about my screen? Can you guys see my screen? Okay, so can you guys see the chart over here? Okay, good. I think the chart is up. All right. Okay, just now the chart was frozen for a while. Okay, so let's start with the euro dollar over here. Okay, just to make sure everything is good. All right, good. The screen is moving. Okay, let's start with the euro dollar. So euro dollar yesterday we flipped to a bearish buyer stance. It came down and stage a bounce. All right, almost hitting the support level at 116.80 over here. So net overall, we continue to see further potential weakness on the euro dollar as it now try to, in the midst of mean reversion decline, we in a short-term uptrend phase that is still intact from the low of 21st of November. All right, so this mean reversion decline to take us down towards the lower limit of this minor ascending channel, which is at 116.80/116.55. And if you do the Fibo retracement of this entire up move from the low of 21st of November all the way up to that spike up on Monday, that confluence with the 38.2% Fibo retracement. So then overall, given the fact that it has broken below and broke below the low of last Friday US session, I would tighten my short-term pivotal support level from a risk management perspective, tighten my short-term pivotal resistance level from a risk management perspective, pardon me, to 117.70. First support level to watch will be yesterday's minor swing low during the start of the US session as well. Okay, before the start of the US session, that is 8 p.m. Singapore time at 117.10. A breakdown below 117.10 will expose our desired near-term support zone at 116.80, 116.65. So once they hit this level over here at 116.80, 116.55, I'll be on the lookout for any signs of a bullish reversal element on the euro dollar, be it a bullish divergence on the hourly RSI or a bullish reversal candlesticks that may form once it hit the 116.80, 116.55. Because given the fact that, do not forget, at this point in time, we're only still expecting a mean reversion decline within a uptrend that is still intact in short term for the euro dollar. Only a bullish breakout above 117.70 will negate today's bearish. Okay, pardon me, a bit of tongue twisting. Let me repeat again. Only a bullish breakout above 117.70 will negate the bearish mean reversion decline view to see a squeeze up and retest this Tuesday high at 117.90, 118 figure level. Above it will continue the bullish impulsive up move sequence towards 118.20, 118.60. So still maintaining that potential bearish mean reversion decline view on the euro dollar using a tightened short-term pivotal resistance at 117.70. So that's for the euro dollar. Next up will be the sterling pound. So the sterling pound broke below our tightened neutrality zone, lower limit of the neutrality zone, bounce, hit and bounce back up, and the bounce back up got rejected at the former minor ascending channel support in dotted pink right now turns into a near-term critical pullback resistance. All right, so it broke down below this minor ascending channel support, previously drawn from the low of 21st of November, giving less credence for a potential bullish reversal scenario. So with that, I will flip to a bearish buyer stance as well for the sterling dollar for today, using 134.10 as my short-term pivotal resistance level, which is also yesterday's rejection level in the middle part of the US session, and also confluence with the pullback resistance of this former minor ascending channel support. First support level to watch will be yesterday's swing low during the European session at 133.25. A breakdown below this level exposes 132.70, 1.3270, which is the intersection between the 20-day and the 50-day moving average. So I'll be also on the lookout on a bullish reversal, we call it candlestick pattern, or a bullish divergence condition on the hourly RSI to flip my honors back towards the bullish bias once the price action come close towards the 132.70 level. So that's for the sterling dollar. Next up will be the Aussie dollar over here. So the Aussie dollar broke down below our neutrality range at 66.15. So that was the lower limit of our neutrality range. So right now, potentially, it's now doing that mean reversion decline as well. Over here to do that retracement of that earlier recovery from 21st of November all the way up to the high of 11th of December. So if you do the Fibo retracement Okay, FIBO level to watch out will be 38%, 38.2%, and the 50% that confluence with the 50-day moving average. So with that, I will flip to a bearish bias view for the Aussie dollar to do that mean reversion decline as well, using the rejection level of yesterday during the US session at 66.30. So 66.30 will be my short-term pivotal resistance today, flip to a bearish bias stance from a neutrality stance that we have yesterday, with the two near-term support level will be at 65.80, 65.40. So as usual, I'll be on the lookout for a bullish reversal candlestick once it hit the 65.40 region close to it, and either also a bullish divergence signal on the hourly RSI. Only a bullish breakout back above 66.30 will invalidate today's bearish mean reversion decline scenario on the Aussie dollar to see a squeeze back up to retest 66.60. Only a bullish breakout above 66.60 will reignite the bullish impulsive upmove sequence towards 66.90, followed by 67.20 in the next few days. So that's for the Aussie dollar. All right. And lastly will be the Japanese yen. So Japanese yen is the dollar yen, pardon me, not the Japanese yen, the dollar yen. Yesterday we flipped to a bullish bias. Still recall for those who follow my daily dose because of the bullish divergence that was being flashed out earlier yesterday on the hourly RSI. And now the hourly RSI is now fast approaching the resistance level over here, fast approaching its overbought level. All right. So, and given the fact that it's also coming very close to our resistance zone as well, or the second resistance level in our mean reversion rebound scenario, which is the 20-day moving average at 15610. So with that, I will flip back to a bearish bias this time around, given that it's coming very close to our resistance level already. The risk reward ratio is not that great. So I'll flip to a bearish bias view for today, using 15610, given that it's coming up approaching our key resistance level in the near term at 15610. So using 15610 as my short-term pivotal resistance level, flip back to a bearish bias view to allow it to float down back towards the lower portion of this minor intraday recovery that has taken shape on Tuesday. So first support level to watch will be at 154.90 over here. 54.90. Okay, 154.90, a breakdown below 154.90 will see a retest on the Tuesday swing low at 154.40 that managed to survive on 5th of December as well, and now confluencing with a 50-day moving average. All right, so a breakdown below 154.40 will definitely intensify this ongoing bearish impulsive downward sequence to expose 153.70 next, followed by 152.95 as it continues to trade within this descending channel from the high of 20th of November. However, a bullish breakout above 15610 will invalidate today's bearish bias view on the dollar yen to see a further squeeze up towards 15660, maximum the swing high area of 10th of December at 157 figure, 157.15 over here. So that's for the dollar yen. Flipping back to a bearish bias view, but with a rather tight short-term support zone or support levels to watch, 154.90 in first step, followed by 154.40, using 15610 as my short-term pivotal resistance level. Okay, so that sum up the intraday technical outlook on the major US dollar pair. So let us now proceed to the major stock indices, starting with the Hong Kong 33 over here. So the Hong Kong 33 squeeze up again, can't break above the first resistance level, which was yesterday's high during the US session at 25,580 before trading back down again. So at the start of the Asia session, we see a positive bullish candlestick. Then thereafter, there is no positive follow through with a what you call it, gravestone doji, followed by a negative candlestick as we are speaking right now at 11:29 a.m. Singapore time. So with that, very likely it may start to trap inside this zone again for today, given that it can't break above 25,580. So with that, I will flip to a neutrality stance for today on the Hong Kong 33, given the current lackluster price action movement that is being depicted right now. All right. So neutral between this critical support level. Okay, let me flip it up. Okay, neutral between 25,120 and 25,580 over here. All right, so 25,120 being the critical near-term support level, which is the minor swing low of 21st of November that managed to survive on the 16th of December, this Tuesday, before staging that bounce. But that bounce can't have a breakthrough above 25,580, have that bearish reaction during the US session, dragged down by the negative feedback loop within those mega cap technology stocks that are related to AI team play. Today's Asia session managed to bounce due to that comforting news flow from China Vanguard, where Vanguard managed to potentially negotiate delay payments on its interest rate bonds, interest rates. We call it interest rate payment on its credit loans from banks, as well as bond delayed payments from bond holders. But that can't have a positive feedback loop, and it created a gravestone doji candlestick right below 25,580. So flip to a neutrality stand for now between 25,580 and 25,120 on the Hong Kong 33. Okay, next up will be the Japan 225. Okay, so Japan 225 managed to bounce around. Okay, so that it drifted, and now it come close to the 48,450 medium-term pivotal support level that we have earlier on. And what we see is that we start to see a bullish divergence on the hourly RSI. So given the fact of this bullish divergence and it's coming down to the medium-term pivotal support level, there could be some form of at least a minor bounce back to mean revert back towards the 20-day and the 50-day moving average. But for today, but in order for it to the bounce, the mean reversion rebounds to have a higher probability, I will have an upside trigger level at 49,310. All right, so this level was previously a minor swing low support level from the low of yesterday's Asia session that was taken down during the US session due to that negative impact on the major US stock indices yesterday. Right, so 4,310 will be my upside trigger level for today to increase the probability of at least a mean reversion rebound back towards 49,850 in the first step, given the occurrence of this bullish divergence condition on the hourly RSI as price action continues to drift down closer towards the medium-term pivotal support at 48,450. So using 48,450, potentially there could be a mean reversion rebound for today on the Japan 225, given the bullish divergence on the hourly RSI, but it needs to break above 49,310 to increase the probability. So 49,310 is the upside trigger level. Once this level is being taken out, the next intermediate resistance to watch out will be at 49,850, which is confluencing with the 20-day and the 50-day moving average pretty closely. Only a bearish breakdown below 48,450 that would invalidate the recovery slash minor mean reversion rebound scenario to see further weakness on the Japan 225 to expose 48,010, followed by 47,570 next over here, which is a 0.764 Fibo extension on the taken from this ongoing corrective decline from the high of 4th of November, the current all-time high, and the minor congestion area of 16th of December and 17th of October. 16th of October and 17th of October, pardon me. So that's for the Japan 225. Up next over here will be the European stock index, which is one of them with the Germany 30. So the Germany 30 broke down below our lower neutrality limit at 24,000, right? Psychological level, it broke down below it. And given the fact that it's now going to drift downwards, so potentially it may continue to drift down to do a deeper retracement now. So if we do the Fibo retracement of this the previous impulsive up move sequence from 21st of November all the way up to the high of 12th of December, 30% will be at 28,860, confluence with the 20-day moving average, and the 50% will be at 23,670 around, confluence with the 200-day moving average. All right, and previously the minor swing low of 2nd of December and 4th of December. So with that, I will flip to a bearish bias for today on the Germany 30 for this ongoing minor corrective decline to continue using 24,070 as a short-term pivotal resistance level. Breakdown below 23,860 may expose further weakness towards 23,670 next. Only a bullish breakout above 24,070 will invalidate today's bearish bias view on the Germany 30 to see a squeeze up to retest 24,235. A breakout above 24,235 may see a push up towards 24,395 next. So that's for the Germany 30. Okay, next up will be the US indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So Dow Jones Industrial Average, yesterday we do have a support level that was taken down. Okay, previously over here. Okay, that's been taken down and now fast approaching the lower limit. Okay, previously was 48,030. This level has been taken down over here and is now fast approaching the lower limit of this minor ascending channel that is drawn from the low of 21st of November over here, and also coming very close to the 20-day moving average as well. So with that, I will flip to a neutrality stance. So yesterday we were bullish, yes. Price action, this move up at the start of the US session. So it almost hit our first resistance level at 48,460. Okay, which was printed high of 48,388, almost there before shaping that bearish Marabozu candlestick and traded lower in the entire US session yesterday. So with that, flip to a neutrality stance on the US Wall Street 30 for today, 48,460 followed by 47,790. So in order to the US Wall Street 30 to escape this ongoing intraday negative feedback loop, we got to have a clearance above 48,460 for sure, where it almost hit and got rejected yesterday. A bearish breakdown below 47,790 will trigger off a minor corrective decline to do a deeper retracement of this ongoing uptrend that was in place since 21st of November. If you do the FIBO retracement to the fresh all-time high that was printed on last Friday, push up higher. Okay, that confluence with the 50%, which is at 47,180. So a breakdown below 47,530 will expose 47,180, 47,180 next. All right, so that's for the US Wall Street 30. Okay, next up will be the S&P 500. So the S&P 500 also broke down below our support level. All right, yesterday we played that we have a bullish bias. Bullish bias almost hit the resistance level at 6,840, printed a high of 6,839 before triggering off and broke below the support level. All right, over here. So with that, we will have a neutrality stance as it's now trying to trade within this dotted gray line over here. So this dotted gray line is the pullback line or the pullback support line of this former descending trendline resistance that was drawn from the current all-time high of 30th of October. All right, so neutral between 6,780 and 6,710 over here at this point in time. So if we start to see a breakdown below 6,710, then we will see a deeper corrective pullback to expose 6,660 followed by 6,610 next. So if we do the FIBO retracement of that previous impulsive upmove sequence from the low of 21st of October all the way up to the current all-time high that was almost tested on the 12th of December last Friday, that confluence with the 61.8% FIBO retracement and the 76.4% FIBO retracement at 6,660, 6,610 next. All right, so that's for the SPX 500. Flipping to a neutrality stance, but watching very closely the lower limit at 6,710. Okay. Next up, the weakest one among the three will be the Nasdaq 100. Right, so the Nasdaq 100 yesterday we were neutral over here. So neutral, it broke above the neutrality limit, can't maintain the upside momentum, tested the 20-day and the 50-day moving average before shaping a bearish reaction candlestick. So indicating that push up above 25,160 is a failure minor intraday bullish breakout before trading down lower. So with that, two resistance level to watch out for on the Nasdaq 100. The first resistance level will be at this 24,940 followed by 25,160. That will be my short-term pivotal support level given how the price action reacted bearishly after the reintegration back below 25,160. So using 25,160, as long as any bounce didn't surpass above 25,160 maximum, we will flip to a bearish bias stance on the Nasdaq 100 for this minor corrective decline phase to extend further towards the downside. Next two support level to watch will be 24,580 followed by 24,300. So 24,580, 24,300. Also confluence with the 61.8 FIBO retracement and the 76.4 FIBO retracement of the previous impulsive upmove sequence from 21st of November push it up to the retrace it to the high of 11th of December, and also this dotted green line here, which is the pullback support of that former descending trendline resistance drawn from the current all-time high of 30th of October. Right, only a bullish breakout above 25,160 will negate the bearish bias tone to see a squeeze up to retest 25,380. Only a breakout above 25,380 will see a deeper minor intraday recovery to test the stubborn range resistance of 25,760, 25,830. All right, so that's for the Nasdaq 100. Flipping to a bearish bias view using 25,160 as my short-term pivotal resistance level. Next up will be the commodities market, starting with gold. So gold continues to be rather firm as it trades within above the 4,267, 4,243 level. All right. So given that it can't break above the 4,355 range resistance that is being in check for now, but given that it seems to us that it's now continues to be in the bullish consolidation phase, as you could see a rising series of higher low that's been take shape since the intraday low of this Tuesday during the European session. So with that, I will have a first support level to watch for today, a slightly higher, this level here, which is at 4,310. Unless price action can have a clear bullish breakout above 4,355, then I could tighten my pivotal support level to 4,310. So for now, pivotal support still remains the same, which is very close to the minor swing low of last Friday and this Tuesday that managed to stage meaningful intraday bounces. That will be at 4,267, 4,243, short-term pivotal support level. A breakout above 4,355 will potentially see a bullish breakout to test the current all-time high at 4,380, followed by 4,430, 4,440 next, which is a Fibo extension cluster level and the upper limit of this medium-term ascending channel drawn from the low of 28th of October 2025. Only a bearish breakdown below 4,243 will invalidate the bearish. Only a breakdown below 4,243 short-term pivotal support zone lower limit will invalidate the bullish bias to see a start of a deeper minor corrective pullback towards 4,205, which is the rising 20-day moving average, maximum 4,155 over here, which is coming close to the lower the lower boundary of this medium-term ascending channel, and also coming very close to the rising 50-day moving average as well. That is confluencing very quickly at 4,155. So that's for the gold XAU/USD. Lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we flipped to a bullish bias stance for a mean reversion rebound. The mean reversion rebound hit our first resistance level over here, okay, which is around this 5640, 5660 or 5670 area, all right, before doing that retracement. So with that, potentially this mean reversion rebound could further extend, heading up towards the 20-day moving average. So we're taking one step at a time. So for today, I will tighten my pivotal support level to 55.75, which was yesterday's intraday swing low during the start of the US session. Resistance zone to watch out for in this ongoing mean reversion rebound in today will be at 5721, 57.54, potentially a breakout above 57.54, potentially see the mean reversion rebound extending further towards 58.22, which is the minor swing high area of 12th of December and confluence with the 20-day moving average. So once it hit very close to this 58.22, I'll be on the lookout for a bearish condition, like a bearish reversal candlestick or a bearish divergence on the hourly RSI at the overbought level. So far, it hasn't hit the overbought level yet on the hourly RSI. However, a bearish breakdown below 55.75 will negate the mean reversion rebound scenario for today to see a retest on this when last Tuesday swing low, Tuesday minor low at 55.23. Breakdown below it may expose further weakness towards 55.450. 54.50, pardon me, 53.46 next. So that's for West Texas oil. So before we go, let's have a quick look of today's heavy key economic data release / events. All right, let's take a look at the economic calendar over here. All right, let's push up the calendar for you guys. All right, so today's economic calendar will be centered on two key central banks meeting and as well as the core US inflation rate. So let's take a look at that. So going forward over here, today will be Thursday. So at this 8 p.m. Singapore time, you have Bank of England interest rate decision. So market participant has almost close to 100% pricing a 25 basis point cut to bring it down to 3.75%. So market participant will now looking at the meeting minutes that will be released at the same time, the statement, potentially, is there any hint of, we call it, potentially this could be the cut for the kind of, put it away that, a cut where it will potentially lead to a long period of pause, all right, at this point in time for Bank of England. So that could become a hawkish cut over here. So market participants will be paying close attention to that on the tonality that's being expressed in the meeting minutes. All right, then followed by ECB at 9:15 p.m. So ECB market is expecting to stand pat for the 6th time this year at 2%. All right, and given the fact that over the last few meetings, several ECB officials has mentioned that potentially the ECB, we call it inflation trend, has started to stabilize, not coming downwards. And if there any mention of confidence in economic growth picking up next year in Eurozone, that could potentially allow ECB to offer at least some kind of normalization policy to take back its 1 year plus of interest rate cut sequence that brings down the default rate to 2%. So there could be a potential interest rate hike on the horizon, at least one in 2026. So that clue will potentially come during the release of this ECB's staff macroeconomic projection. So that will come after ECB President Lagarde press conference at 9:45 p.m. So at 10:45 p.m., they will release the latest macroeconomic projection. So this projection involves a kind of forecast from ECB on their view of the economic growth trend in Eurozone, inflation trend in Eurozone, and it will take into account of 2028 as well. So if we start to see a pickup of inflation trend followed by growth trend in the ECB Eurozone region, that could increase the odds of at least one interest rate hike in 2026, potentially put an end to this 2 year plus of interest rate cut cycle by the European Central Bank ECB. So that could actually offer some form of support from the euro dollar once we mentioned that it comes very close to the 11680/11655 level, where I'll be on the lookout for possibility of a bullish reversal candlestick, coupled with as well as a bullish divergence signal condition on the hourly RSI. Once it comes close towards this key risk event, will be at 9:45 p.m. 9:45 p.m. with ECB press conference. ECB press conference, 10:45 p.m. will be the release of ECB macroeconomic projection. So that's all in Singapore time. Yeah. Then slightly above it, we have the core inflation rate coming out from US. So this time around 9:30 p.m. Okay, it will be month of November. So October they will not release. So there will be a empty period for 1 month. So market participants are still looking at a high ball number at 3% year on year. So if you look at the trend on the core inflation rate in US, excluding energy and food, so that is a rather high ball number, all right, at 3% over here. So that already been baked into the market expectation that they do expect inflationary trend in the US to continue to remain elevated, holding above the 2% target that the Fed wants to get desired. So if it starts to maintain within expectation at 3%, I do not see it moving a needle or impact the global markets movement, especially the FX movement. But if it starts to slide down lower at around 2.9%, that could actually give the dollar the reason for the dollar bears to reposition themselves again after the profit taking that has taken shape yesterday. Right, so something to look out for at this timing, which is 9:30 p.m. Singapore time, the release of the core US inflation, where market has really assigned a rather high expectation number at 3%, the same rate as the previous we call it September print, because October it did not release. All right, there'll be no release for October. Okay, so now that's the key we call it risk event taking shape before the start of the US session and heading into the first hour of the US session at 10:45 p.m. Singapore time. Then thereafter we have a rather quiet session over here, right? Okay, a very quiet session until tomorrow Asia session. We also have another key risk event more pertaining to the dollar yen and the Nikkei 225. So at 7:30 a.m. we have Japan inflation rate, and this Japan inflation rate will be released before BOJ. So core inflation rate, market participants is still expecting at 3%. That's considered a high rate. So far, about for 1.5 years, the core inflation rate and the core inflation rate has been hovering above BOJ desired target of 2%. So that has already been baked in to allow Bank of Japan to do the second interest rate cut for this year at 0.75 to hit it 0.75%. All right, so that will be baked in. So what market participants will view next will be, I'm not sure whether this is correct or not, because usually I know why Bank of Governor Uda, based on trading economics, he mentioned that he will be speaking before BOJ interest rate decision. So I'm not sure he's allowed to speak anything about monetary policy or some other things else, because that will actually contradict the, we call it, their policy of speaking before key interest rate decision. So the interest rate decision, traditionally it will be at 11 a.m. Sometimes it may take a bit longer to announce the market. Then thereafter, around between 2:30 p.m. to 3:30 p.m. Singapore time, BOJ governor will give a press conference on the decision that was being made earlier. So market participants will be hearing very closely his press conference. How does he wants to message the messaging across over here? So I likely he will give a rather guarded tone, because he also do not want to be turned to ultra hawkish, where speculators may start to sell off the longer term JGB bonds and create a spike up, a one-way spike up in the 10-year and the 30-year JGB yield, which is undesirable for the current state of public finances in the new Japanese administration, where they embark on the aggressive fiscal policy. So I believe there could be some messaging of balanced tonality by Bank of Japan Governor Uda during the press conference. So that will be much more of a bigger interest to the market participant, given that almost 100% chance market participants expecting the BOJ interest rate to get up by 25 basis points on Friday to bring it up to 0.75%. So that sum up the daily dose of market insights for today. We shall speak again tomorrow. Have a great day ahead. Thank you.